Hello and a great welcome once again to this particular session. And in the last one, you remember, we finished till up to 2.2. Now, today, obviously, we are going to start off with question number 2.3. Correct? So, question number 2.3, just have a look. In case if you have downloaded the notes, so you can just simply have a look over the notes which you are having right now, I presume so. So, 2.3, it's a bit stronger question than the two actually which we have done so far. So pay attention. Following is the draft balance sheet of Divers Limited having an authorized share capital of 1,000 crore as at 31st of March 2021. And you have been given non-current assets and non-current assets, property, plant and equipment. In the outer column it is given 600. Now this is the balance sheet of Divers Limited. You need to remember that. And here it is written gross less 200. Gross stands for cost. Gross less 200, and in the outer column it is written 600. What does it mean? So let me pick up a rough paper too. So far this particular point means this is Divers Limited. Divers Limited. Correct? This is Divers Limited. As far as Divers Limited is concerned, we have been given that net value, because less depreciation, it is written less depreciation. So less depreciation is 600, and you can see the value which is written in the outer column is 800. Correct? Quite obviously it means the gross value must have been how much? In the outer column it is written actually 600, I am extremely sorry, and depreciation is 200. So quite obviously it means the gross value must have been 800. In the outer column it is written 600, isn't it or not? So Divers Limited, we may say, is having what we call property, plant and equipment, and its gross value is 800, which is not given straight away, but we found it out because depreciation is given 200 and the net value written is 600. Then we have been given, in this case, financial assets. Now under the financial assets, investments are generally written. So basically you have next item as investment, and value of investment which is given to you is 1,000. Value of investments which is given to you is 1,000. How much? It is 1,000. Then you have been given current asset. Current assets are actually 3,000. So you write here current asset. Current asset is equal to 3,000. Clear? Current asset is equal to 3,000. Then besides that, we have been given equity and liability. So as far as assets are concerned, these are the items which have been furnished to us in this particular question. Now we have a look over the equity and liability. As far as equity and liability is concerned, and even under equity, we have equity share capital. So as far as equity share capital is concerned, one share is of 10 each, and total equity share capital which is given to us is 250. Other equity which is given to us is 1,350. Besides, we have been given liabilities, and under the liabilities we have non-current liability, but there is no item of non-current liability. Then nowadays we also use a term financial liability. Actually under liabilities we write non-current liability. Under non-current liability we write financial liability like borrowings, secured loan, etc. Actually there is financial liability in the form of borrowings. You write secured loans. Actually it is not written. So borrowings or secured loans you have been given to the extent of secured loans. Secured loans in this case to the extent of 1,000. To the extent of 1,000 it is given to us. Correct? Now we have in this case current liability. Current liabilities are actually 2,000. So current liability is equal to 2,000. This is the information with respect to Divers Limited. Correct? In this page we have been given the balance sheet. Now I move over to the next page. So I will keep this sheet over here. Now in the next page some important information is furnished to us. The company consists of two divisions. Now it is mentioned that this company has got two divisions, and one happens to be established division. One is established division, and next one is, we will see later on, new project division. These are the two divisions. One is established division and another one is new project division. There are two divisions of this particular entity. Correct? Two divisions. Now further we have been given in this case establishment division whose gross block was 200. Now gross block of establishment division is 200 crores and net block was 30 crores. Now pay attention here. Gross block means fixed asset. Fixed asset means property, plant and equipment. What does this line stands for? Now as far as establishment division is concerned, establishment division is concerned, we have been given that gross block is 200. Actually, this organization is having gross block to the extent of 800. However, here it is mentioned that this division is having gross block to the extent of 200. That automatically leads us to the fact that this particular division must be having gross block. Gross block means property, plant and equipment at cost. So 800 minus 200, this particular division must be having gross block to the extent of 600. It can be safely assumed or not, isn't it or not? Now further we have been given establishment division whose gross block is 200 crore and net block is 30 crores. Now its net block is given to you 30 crores. That means the net value of property, plant and equipment is 30. Now if I would say that gross value happens to be 200, quite obviously one need not require much mental exercise to know what would be the value of depreciation. So now we may say depreciation of property, plant and equipment which is related to establishment division must be 170. Now just pay attention. Now Diverse Limited, which is having two division. The Diverse Limited is having total depreciation of 200, out of which 170 relates to what we call this division. So quite obviously if I am going to subtract what we call 170 from 200, I will be left off with 30. This 30 will become the depreciation on property, plant and equipment related to new project. Now the gross value is 600, depreciation is 30. So we come to the conclusion that it must be having net value of 570. So that is how we have segregated the what we call value of property, plant and equipment into these two divisions. Further now it is given, one is establishment division and second one is new project division, to which the remaining fixed asset and current liabilities related. It is clearly given company consists of two divisions, one is establishment division and second is new project division, to which the remaining assets. So whatever remaining amount is there of property, plant and equipment must belong to new project now. Is it clear? The following scheme of reconstruction was agreed upon. Now a reconstruction scheme or rearrangement scheme has been agreed upon. Two new companies, Sunrise Limited and Khajana Limited, to be formed. Now the question states that two new companies are going to be formed. Two new companies are going to be formed. Let me take another rough sheet so that I can explain it better in a better manner. Now question states that two new companies are going to be formed. I have already told you this is your diverse division. This is your diverse limited entity, and this entity is having two divisions. We have already seen establishment division and new project division. Now the question states that the scheme of reconstruction this particular company has gone for, they want to reorganize their entire affairs, and for the same they have formed two new companies. Two new companies, Sunrise Limited and Khajana Limited, are to be formed. Sunrise Limited, these are new company. Sunrise Limited. Two new companies are formed. One is Sunrise, another one is Khajana Limited. Further, we have been given their authorized share capital. Question states that the authorized share capital of Sunrise Limited is 1000 crores and authorized share capital of Khajana Limited is 500 crores. Correct? Now you have been given Khajana Limited is to take over investment at 800 crore. Now we come to some important point. Khajana Limited, whose authorized share capital is 500 crores, although we are not much concerned with the authorized share capital, but it is given in the question that this particular entity, point number A, it is not flashing on the scheme right now. Two new companies, Khajana and these are formed. We have already gone through this one. Now point number B actually I am talking about. Point number B states that Khajana Limited is to take over investment at rupees 800. So investment as far as is concerned, if we will look into the question carefully, this investment which is given, it is at fair value. You must have looked at the question. Here is the question. This is the fair value. Investments are carried at fair value of rupees 1000, correct? Now this investment is taken up by Khajana Limited. And Khajana Limited took over this particular investment which is having a fair value of 1000 in the books. Khajana Limited is taking over these investment for rupees 800 only, correct? As per this information. Also it is written in unsecured loans at balance sheet value of 600 crore. They are not only taking investment, they are also taking over unsecured loan. Now, as far as balance sheet is concerned, in the balance sheet, you must have noticed that unsecured loan which is given in the form of borrowings, that is 1000, correct? It was 1000. Moreover, we have also written over here, unsecured loan 1000. So out of this 1000, we have just seen that 600 worth of secured loan has been taken over by Khajana Limited. So remaining loan at book value is 400. Out of 1,600 worth of loan is taken over by Khajana. So quite obviously our conclusion will be very simple. The remaining loan at book value is 400. What we will do regarding that? At this moment we cannot say with surety. Anyway, as far as unsecured loan is concerned, that is taken over at rupees 600. This is the information furnished to us. Further, in this question it is given now, Khajana Limited, it is to allot 1000 equity share, point number B, it is to allot 1000 equity shares of 10 each at par to the members of Diverse Limited. Now Khajana Limited is taking over these two assets, and Khajana Limited will deliver the consideration in the form of equity shares, and one equity share will be of rupees 10 each, and they will deliver the consideration to members, to the members. Remember one thing, to the members. However, what is the amount of purchase consideration? That is not given to us so far. Only thing given to us is that Khajana Limited is going to allot equity shares of 10 each at par to the members of the Diverse Limited in satisfaction of the amount due under the arrangement. The arrangement is that they are taking over our investment and unsecured loan, that's all. The book value of loans approximates the fair value. Further question states that whatever value of loan is written in the balance sheet, that approximates the fair value, means actually that is almost equal to the fair value. Put it in other words, it means whatever the value of secured loan is given, this is nothing but this is also fair value. So we can safely assume that this is also fair value. We will use this when we will do the entries in the books of Khajana Limited, correct? In case, if the case of Khajana Limited becomes a case of acquisition accounting, because in that case we may have to be concerned with the fair value. Further, it is given in the question, point number C, Sunrise Limited is to take over property, plant and equipment and net working capital of the new project division. Now, this is Sunrise Limited. Sunrise Limited is taking over property, plant and equipment. Property, plant and equipment of new project division. It is taking over new project division. New project division. Now, if you remember, just a moment ago I told you this is the new project division, this is the establishment division. Property, plant and equipment at net value is 570. So we may say that Sunrise Limited is taking over property, plant and equipment at net value of 570. Further, it is given and net working capital of new project division along with secured loans and obligation. I will go through the next line, but so far what we have seen, property, plant and equipment is taken. Along with that, they are taking over secured loan and they are taking over working capital. Working capital means current asset and current liability. Working capital basically means current asset and current liability of new project division. But problem is that how to find out the value of current asset and current liability. Now we come back to this particular page, correct? Here what we tried to actually segregate the items. When we were going through this particular line, point number 1, establishment division whose gross block is 200 crore and net block was 30 crore and current assets were 1500. Now it is given to us that establishment division, okay, current assets are written over here. I will use this term, or you want me to, I will do it separately. Establishment division and new project division. Question states that current assets are 1500 crores of establishment division. Now look here carefully. Total current assets of the organization is 1300, and out of that 1500 worth of current assets are related to establishment division. So we can safely presume that current assets remaining must be of new project division. Number 1. Number 2. Further it is given and working capital of 1200. That means establishment division is having a working capital of 1200. They are having current assets of 1500 and working capital of 1200. Now if I subtract here 300, it is nothing but your current liability. So now we can say current liability of establishment division is 300, current asset is this much, and working capital is 1200. Now we can easily find out the current liability of new project division. How we can find? We know that total organization's liability is 2000, current liability is 2000, and current liability of establishment division is 300. So we can safely say that current liability of new project division must be equal to 1700. We can safely say so. So now here we have bifurcated it. So current liability of new project division is 1700 and their working capital will be negative. So importantly, now we come to know that Sunrise Limited has taken over property, plant and equipment of Sunrise Limited. Of course, it is worth 570, and current asset we have just found out is equal to 1500, and current liability we just saw is equal to 1700, correct? New project divisions I am talking about, new project divisions. Further, it is also given that they are taking over our secured loan. But the point here is that out of total secured loan of 1000, as I was talking about earlier, out of 1000, we have already seen that 600 crores, 600 worth of loan is already taken over by K. The remaining is 400. So obviously it means only the remaining amount could be taken up by Sunrise Limited, isn't it or not? So that's the reason here we are going to put up 400. So now we can say, as far as Sunrise Limited is concerned, they have taken two assets, property, plant and equipment and current asset, and besides that two liabilities, current liability and secured loan. So after analyzing point number A, B, and now we move over to point number C. Once again, Sunrise Limited to take over property, plant and equipment, net working capital of the new project along with secured loan and obligation to capital commitment for which Diverse Limited continues to stand guarantee at book value. What does it mean? If you will look carefully into the question, at the end of the balance sheet in the footnotes, we have been given there are some capital commitments of rupees 700 crore. We know that capital commitments are similar to liabilities, contingent liabilities, which are presented under the footnotes. So we might have committed with respect to capital commitments. So Diverse Limited is having capital commitments of 700 crore. Sunrise Limited is also taking over and obligation for capital commitment. So that means when we will prepare the balance sheet of the Sunrise Limited later on, then under the footnote I will write that they are taking over capital commitment. They are taking over this liability, contingent sort of liability, you may say, because it is written in the footnotes. And this line is just given to confuse you, that for which the Diverse Limited will stand guarantee. Generally, it happens in practical life. If some other entity is taking over your capital commitment, then generally the capital commitment which originally belongs to, that means it originally belongs to Diverse Limited. So Diverse Limited has given a guarantee. Guarantee in the sense means in case what we call if you will not be able to fulfill these capital commitment, we will fulfill. So there is no harm in taking over these what we call items. So that might be the reason why Sunrise Limited is taking over it. Now the next point is, it is to allot 1 crore equity shares of 10 each as consideration to Diverse Limited. Now pay attention here. Now it is given that they are going to give us consideration in the form of 1 crore shares. 1 crore shares of rupees 10 each. That means total consideration will be 10 crores. And this consideration is being given to demerged entity, Diverse Limited, not to the members. Correct? So this is the point. Further, it is also given, and that's a very strong line, Sunrise Limited made an issue of unsecured convertible debentures of 500 crores. Sunrise Limited is issuing what we call convertible debentures of rupees 500 crore, carrying interest at 15% per annum and having a right to convert the equity shares of 10 each at par on 31st of 3/2021, whatever it is. Simply put, they are offering what we call unsecured convertible debentures of 500 crore at an interest rate of 15%. But the important point, and these debentures, it means are convertible into equity shares of 10 each. The issue was made to the members of Diverse Limited. This issue was given to the members of Diverse Limited as a right whom grabbed the opportunity and subscribed in full. They grabbed the opportunity and subscribed it in full. Now this line is interesting in the sense because, first of all, let me write here, they are offering 15% debentures. 15% debentures, of course convertible debentures, worth 500 crores, and these debentures are being given, or should I say have been subscribed by members of Diverse Limited. Of Diverse Limited. Members of Diverse Limited. Now pay attention here. Because Sunrise Limited is offering these debentures, so they are going to receive cash. In the books of Sunrise Limited, we will pass an entry bank account debit to 15% convertible debenture. Simple entry as we normally do. However, another entry will have to be passed in the books of Diverse Limited. In the books of Diverse Limited, what entry we are going to pass? In the books of Diverse Limited, we are going to pass entry investment in, because we are investing our amount in the debentures of Sunrise Limited. Diverse Limited, we may say, is investing the amount in Diverse Limited because Diverse Limited is the issuer of the debenture. And members of the Diverse Limited are investing in it. So we will write investment in debenture account debit to bank account. Is it clear to you? Now here I just want to caution you. Whenever debentures will be subscribed by members, even in that case, Diverse Limited will have to pass the entry. Is it clear to you? Unlike equity shares, unlike when consideration is directly received by the members, generally we have seen actually, in that case we say that demerged entity is not receiving anything because the members are receiving. But whenever payments will be made, in that case, Diverse Limited will come into picture. That is the reason Diverse Limited will have to pass the entry. Correct? So this particular transaction require entry in the books of Sunrise Limited and both in the books of Diverse Limited. Because Sunrise Limited is issuing the debentures and Diverse Limited indirectly is investing into it. That is the reason. Further, we have been given Diverse Limited is to guarantee all liabilities transacted to the two companies. It is a normal common feature of arrangement whenever it happens in practical life, merger, splits off. Generally, the demerged entity becomes responsible for all this thing, otherwise other parties may not be willing to take over our liabilities. So we have given them a guarantee regarding all the liabilities which we have given to them, or should I say which the liabilities they have taken. Diverse Limited is to make a bonus issue of equity share in the ratio of 1 share for every equity share. 1:1 is the ratio. Now that means another entry we will have to pass in the books of Diverse Limited regarding bonus issue. A bonus issue is in the ratio of 1:1. So whatever is their share capital equal to that bonus issue will be there, because for every share we are issuing another share. And as we know, actually, as far as bonus issue is concerned, we write the entry reserves account debit to share capital, and this entry you have done so far in your earlier phases of education. So this is the situation. Further, it is given in the question that you are asked to pass entries in the books of Divers Limited, and point number F is very important. None of the shareholder hold more than 50% and not related to each other. It means actually, as far as Sunrise Limited is concerned, that is not a big issue, because here Sunrise Limited is giving the consideration to the demerged entity, so it is quite obviously a case of common control. Here we don't have any doubt, and we need not require to shed much what we call efforts to know whether it is a case of common control or not, because consideration is given to the Divers Limited. It is a case of common control. However, when consideration is given to the member, in that case we need to know whether it is a case of common control or acquisition accounting, because in that particular case we need to find out whether any member is still having what we call shares in excess of 50%. So now the question has made it absolutely clear that none of the member is having more than 50% stakes in the new company. So quite obviously, in this case, first of all, we may say it is not a case of common control, and in this case, Ind AS 103 will come into play. That doesn't mean that Ind AS 3 will not come into play in case of common control. Logically, Ind AS 3 will not come into play, but Appendix C of Ind AS 103 will come into play when it is a case of common control. But the basic difference is that because Ind AS 103 is coming into play, in the books of acquirer, when I am going to pass the entry later on, I will have to consider the fair values, while in case of common control, as you know, actually we take into account only the book values. That's the basic difference between these two accounting. So this is how I have made the threadbare analysis of this question. Now I will keep the sheets of these two questions away. Just wait. Correct? So such a long question, you can see it is very important to do a threadbare analysis. I will keep these sheets over there. And now where are my rough sheets? These two sheets are vital for me. I will keep them here. So for reference, and rough sheets now I will keep away. These are the rough sheets. And now I come to the main sheets. Correct? And I'll pick up my pen. Here it is. So this is your question number 2.3. Very strong question. I have already told you. Pretty strong question. Correct? 2.3. Question number 2.3. Even though I have used the rough sheets, you must note all these things, because that will hold you in a very good state later on in case if you want to refer. Correct? So 2.3 is concerned, first of all, what we are supposed to do in this particular question. Of course, we need to prepare the journal of Divers Limited. Journal of Divers Limited. That is demerged entity. That is the demerged entity, correct? Now, in order to prepare the journal of Divers Limited, first of all, you let me know actually what entry you are going to pass in this case. You are first of all going to take, because this time Divers Limited is entering into two transactions. In the previous two questions, only one division was being sold. Logically, even in this question, one division is being sold. Technically, because only establishment division is still there, only new project division is being taken over by the Sunrise Limited. Besides, we are entering into what we call tie-ups with or transactions with two companies, Sunrise Limited and Khajana Limited. So Divers Limited, when will prepare its books, first of all will write a transactions related to or transaction with Khajana Limited. First let me write transactions with Khajana Limited. Khajana Limited. Correct? Now, the problem here is that, as you know, the first entry is with respect to transfer of assets and liabilities, and generally we have a habit of what we call debiting the entity with the amount of purchase consideration. We do not know what is the purchase consideration because as far as Khajana Limited is concerned, it is not given in the question very clearly how much they are supposed to pay us. Anyway, Khajana Limited account debit. We will have to find out the amount of purchase consideration which we do not know at this particular moment. They are taking over only two items. One is unsecured loan. So I will debit unsecured loans. Unsecured loans account debit to the extent of 600. Correct? 600 worth of loan was taken over by Khajana Limited. And they are taking over our investments. Our investments. Now here, you have to be very careful because this could otherwise lead to wrong solution. It is given that they are taking over our investment for rupees 800. So logically I should write here 800. But as I told you, now coming into picture is Ind AS 103 because as far as case of Khajana Limited is concerned, this is here acquisition accounting will appear. And that's the reason we are not going to write here 800, we are going to write here 1000, that is fair value. That is the reason actually why it is very important. Now purchase consideration is not given, but we can find it out very easily. If somebody takes my asset worth 1000, correct, and my liability of 600, how much he is supposed to pay me? He is supposed to pay me 400. So we will take the difference of these two. So purchase consideration will become 400. So that means we are supposed to receive 400 from Khajana Limited against taking over unsecured loan and investment. Important is why we have written investment here at fair value, because here acquisition accounting is coming into play. Secondly, now the next one is no profit and loss actually arose in this particular case. Now the next one is with respect to consideration. As far as consideration is concerned, now we are supposed to receive from Khajana Limited. So here I am going to write Khajana Limited. Khajana Limited 400. But problem is this, I am not going to receive, my members are going to receive. So I told you here it is better to write reserves and surplus. In fact, you can write capital reserve also, reserves and surplus, or simply you can write other equity, whatever you may like to write. You can write reserves and surplus, or you can write other equity. So it will be considered as a sort of loss because you are not receiving the amount. At the same time, you are crediting the Khajana Limited. Correct? So these two entries will pass with respect to Khajana Limited. However, we will have to pass entries related with Sunrise Limited now. Transactions with Sunrise Limited. With Sunrise Limited. As far as Sunrise Limited is concerned, if you remember, Sunrise Limited, it was given when we were analyzing the question that will deliver us 1 crore shares of rupees 10 each. That means the consideration is 10 crores. All figures are in crores. Correct? Now Sunrise Limited has also taken over 2 liabilities and 2 assets, if you remember. Unsecured loan, out of 1,400 crores worth of loan is taken over by Sunrise Limited. And they have also taken over our working capital, that is current liability and current assets, and working capital was 1,700, which I have written in the rough sheets, correct? When I was analyzing the question, I have written here current liability 1,700, current asset 1,500, property, plant and equipment 570, correct? So 2 liabilities they have taken. Besides that, they have taken over our property, plant and equipment of new project division. I will write here the net value and the net value is 570. Two current asset, 1,500. 1,500, let me check. Yes, it is 1,500. And then we are going to actually tally it. So the balancing figure will be our capital reserve. We can write profit also, but ultimately profit will be transferred to capital reserve. So why to waste time? Straight away transfer the profit to capital reserve. 40. Correct? I think it will be 40. You must make a check. Now, demerged entity will receive the consideration of 10 crore and they will receive the consideration in the form of equity share. Equity shares of Sunrise Limited. Of Sunrise Limited, debit 10 crores to Sunrise Limited. Now the account of Sunrise Limited will get closed. Is it clear to you? 10 crore worth of shares we have received now. Now besides that, in this question, Sunrise Limited, actually at this moment we are passing entries in the books of Divers Limited. But it was given in the question that Sunrise Limited is making issue of 15% debenture and that issue has been subscribed by our members. And I told you whenever debentures will be subscribed either by members or by the entity, we will have to pass the entry. Correct? So I will write here investment in debentures of Sunrise Limited. Investments in debentures of Sunrise Limited to the extent of 500 crores. And to bank we shall write here. Because this decision must have been taken by Divers Limited. Whereas when consideration is given to the member, that decision is generally taken by the new company. So that is the reason, even though members are subscribing to these what we call debentures, it will be considered as if Divers Limited is what we call investing this amount. Correct? To bank 500. Besides, and remember one thing, corresponding entry will appear in the books of Sunrise Limited. These are books of Divers Limited. Further, it was given in the question, okay, this sheet is over now. Where to keep these pages? This is another problem. Now the next one is entry number D. There was some bonus issue, entry number C or D, entry number D. So when Divers Limited will make bonus issue, it will write reserves and surplus account debit or other equity account debit. Reserves and surplus account debit to share capital. Now, if you look into the balance sheet, total share capital of Divers Limited is 250. And for one share, we are giving one share. So quite obviously, 250 worth of bonus issue must be there. So 250. So this is how the entries will be passed in the books of what we call Divers Limited. Obviously, now you are interested in making the balance sheet of Divers Limited also. This will become your step number 2. Balance sheet of Divers Limited. Balance sheet of Divers Limited, of course, after reconstruction or after arrangement or after don't write here demerger, because basically here it is a sort of arrangement. So balance sheet of Divers Limited after reconstruction or after arrangement, you can write. It would be better. Why to give any chance to the examiner? Assets. Now could you tell me, while preparing the balance sheet of Divers Limited, what point I will take into account? We have done so many questions. First of all, think very coolly. Earlier there were two divisions. One division, new project division, has been taken over. So logically now all items related to establishment division only will find place in this particular balance sheet. Now property, plant and equipment at net value, I will write here net. Moreover, in the balance sheet I will have to put it at net value amount. Now if I will look into that particular sheet, correct, this is establishment division, and 30 worth of property, plant and equipment is there. So I will write here 30. It is as simple as that. Correct. Now after non-current asset there was investments, isn't it or not? There was investments in the form of financial asset. Now investment, pay attention. You had earlier 1000 worth of investment in the balance sheet, but that 1000 worth of investment has been taken over by whom? Taken over by Khajana Limited. So your investment becomes nil. However, don't forget that you have just made an investment. You have made an investment in the form of debentures. You have made investment in the form of debentures to the extent of 500. To the extent of 500. Are you getting my point? What is this 500? That is your investment in debentures. You can write it by yourself. Further, I will also add 10. So what is this 10? Don't forget, where is that sheet? That is the problem. In order to make you understand, I have to do lots of things. You have received equity share of Sunrise Limited. You can also write it this way: investment in shares of Sunrise Limited. These equity shares are nothing. See, it is having a debit balance. If equity share capital is having a debit balance, what does it signify? It signifies your investment in that company. Because now you have received shares of Sunrise Limited, that means you are an investor to the extent of 10 crore in Sunrise Limited. So two investments are there now. So these two investments will find place now. I hope you got it. So 510 will be the amount which will appear now in the balance sheet. Is it clear to you or not? Now besides that, we have current asset. As far as current assets are concerned, I told you the entire organization's current asset. Where is that sheet? 3000. Out of that, new project division's current asset gone out, we are left off with 1500. Correct? So we had current asset to the extent of 1500. However, here you will have to exercise caution. I am subtracting here 500. Sir, why this 500? If you remember, I just passed an entry over here. Investment in debenture account debit to bank account. So my current asset will get reduced due to this investment, isn't it or not? So that's the reason actually this 500, right, for your reference, this 500 is due to investments. So your current asset will now be equal to 1000. Now you will total it. So your total amount will be 540 plus 1000, 1540. 1540 will be total of your asset side. Clear? I hope so. Now we move over to our liability side. As far as liability side is concerned, equity and liability. First of all, I am going to write here one, equity. Under equity, as you know, we generally write share capital first. Now you let me know how much was the share capital of Diverse Limited prior to the arrangement. So 250 crores. Very good. And we have passed an entry reserve and surplus account debit to share capital because of our bonus issue. So share capital will get credited 250. So ultimately it will be equal to 500. Don't subtract the debit balance of equity share capital. That debit balance of equity share capital always refers to investments. Is it clear to you? Now, however, in the examination, you can write in bracket that out of these 500 shares, 250 shares have been issued as bonus issue. You can write it in the examination this way. Now, I am going to take other equity. As far as other equity is concerned, other equity. First of all, I will look into the balance sheet. What was my equity? That is, even I have forgotten myself. So I will have to look here. Other equity balance is 1350. So other equity balance is 1350. Other equity. Now, out of this equity, you will have to subtract 400 because of the fact that you did not receive the consideration from Khajana Limited, where we debited reserve and surplus. However, I am going to add capital reserve due to my transaction with Sunrise Limited, because over there I earned a profit which I transferred to capital reserve. And because of bonus issue, we utilized 250 out of our reserves and surplus, means out of our equity. So these two items will be subtracted from 1350 and we will add 40. So that will be equal to 740. Now, second, liabilities. As far as your liabilities are concerned, one is your non-current liability. Under non-current liability, there is financial liability in the form of borrowings or unsecured loan. Unsecured loans. However, nothing will come over here because no loan is left now. Finally, we shall write here current liability. Current liability related to establishment division is 300. So now we will tally it up 800, 1540. So ultimately our balance sheet gets tallied 1540, 1540. So far we have reached step number 2. I will keep the sheet now over here. This was the major step. However, in this question, there is another company, Sunrise Limited, wherein you will have to do bit of effort. Sunrise Limited, step number 3 now. Step number 3. Here I write Sunrise Limited. That means in the books of Sunrise Limited. First of all, you let me know what entry actually I am going to pass in the books of Sunrise Limited. Although it is not asked, and neither it makes any point to ask, because hardly any entry is there. Whatever assets they have taken up, we are going to put it up over here. Now, where is my sheet? Sunrise Limited has taken over our non-current asset in the form of property, plant and equipment to the extent of 570. They have taken our current asset to the extent of 1500. And in the rough sheet, I have written they have taken over our current liability and unsecured loans. Correct? So, I will write here 2, current liability, 1700. And they have taken over our secured loans to the extent of 400. And they are supposed to pay consideration of 10 crores. The balancing figure I will debit to capital reserve actually. I think balancing figure is appearing here. So capital reserve. Don't write goodwill, because here you are going for common control. Under common control, appendix C is very clear, no new asset should be recognized. So that's the reason actually it is better to debit. Although I have told you in your module it is written goodwill, but it is better actually to take it as capital reserve, because case of Sunrise Limited falls under common control, isn't it or not? Just wait. Now, we will receive the consideration. But before that, consideration will be paid by Sunrise Limited. Consideration account debit. ₹10 crores, and they have paid the consideration in the form of equity share capital, 1 crore equity shares of ₹10 each. Don't forget that they have made a issue of 15% debentures, correct? That was the point I was talking about earlier. So when they will make a issue of convertible debentures, you will write the entry to 15% debenture account or convertible debenture account, 500 crore, 500 crore. So this is how the entries will be passed in the books of Sunrise Limited, correct? In the books of Sunrise Limited. Just let me adjust the mic portion because shadow is falling on the sheet. You have to take care of so many things. Anyway, now I will prepare the balance sheet. Simple to prepare the balance sheet. Assets, non-current asset. Under the non-current asset, you write property, plant and equipment at net value 570. At net value 570, you are going to write it over here, correct? Then you write current asset. You have taken current asset worth 1,500, but because you made a issue of debentures, so your value of current asset will increase by 500 because of 500 bank balance, which you will receive more. So 2,000. So your total will be 2,570. Total will be 2,570. Now you are going to write here equity and liability. Equity and liability. As far as equity and liability is concerned, first of all, you are going to write here equity. Under the equity, you are going to write share capital. Because you are a new company and you have just issued 1 crore equity shares of 10 each, so your share capital is 10, moreover it is reflected here. Then other equity. As far as other equity is concerned, you have a debit balance of 40 in the form of capital reserve. So you will write here capital reserve, but capital reserve is reflecting a debit balance, 40. Besides that, now you will write liabilities. As far as liabilities are concerned, you have in this case non-current liability in the form of unsecured loans. So I will write here non-current liability. Under non-current liability, logically we write financial liability. Under financial liability, I will write unsecured loan. Unsecured loan worth 400. Also this time we have 15% debentures. We have made an issue of convertible debenture. So even debenture will fall under this category. And then I am going to write current liability. Current liability was worth rupees. We took current liability worth 1,700. So 10 minus 40 minus 30, 370, 500, 1700. So 2570 should be your total. Correct? This is how the balance sheet of Sunrise Limited will be prepared. I've already told you it's a pretty long question. You cannot receive such a long question. First of all, let me make it absolutely clear. They may ask you to prepare what we call balance sheet and general in Diverse Limited or in a particular company, not simultaneously in all the four companies. Although just for understanding, I am doing the solution in all the four companies, Diverse Limited, Sunrise Limited, Khajana Limited, correct? Sorry, all three companies. Khajana Limited now, step number 4 or 3, I have forgotten. Anyway, I will take it as 4. Step number 3, I think, Khajana Limited. As far as Khajana Limited is concerned, if you are going to prepare the journal, correct? Khajana Limited has received only investment from your side, investment account debit 1000, because Ind AS 3 will come into play, no book value, and 2 unsecured loan. Even unsecured loan is at fair value, because it is given in the question that whatever amount of loan is written in the balance sheet, that approximates the fair value, so we can safely assume this is the fair value. Then, to consideration. They are supposed to pay a consideration of 400. This is the first entry which Khajana Limited will pass in its books. Next one is consideration, discharge of consideration. Consideration account debit. Now they are going to discharge consideration. Consideration account debit 400 to share capital. That is 400. Correct? Is it clear to you? So this is how the entry will be passed with respect to Khajana Limited. Now, if suppose you want to prepare the balance sheet of Khajana Limited, there is nothing in it. Assets, non-current asset. Under non-current asset, property, plant and equipment. You haven't taken any property, plant and equipment. Financial asset, you have taken investments. Financial asset, so you will write investments 1000. That's all. No current asset has been taken. Equity and liability. As far as equity and liability is concerned, share capital. Share capital 400 they have issued. It is also better to mention, because it was given in the question. By way of note, you can mention that their authorized share capital is so and so, but their issued, subscribed and paid up is 400. Other equity. No other equity, because no capital reserve etc. is there. However, second, when I will write liability, under liability, non-current liability. Under non-current liability, there is financial liability, and under financial liability, there will be unsecured loans. They had taken our loans to the extent of 600. So this is how the balance sheet of this particular entity will be prepared. So you must have noticed that it was a pretty long question, very long question in fact. When we will go for the next session, in the next session we'll attempt section 3, no doubt about it, but it was pretty long question, almost you can say, although it is one question, but this one question itself is equal to 2-3 questions. But after having gone through this particular question, you must feel supreme amount of confidence. So as usual, looking forward to have your feedbacks. The more feedbacks we have, the more motivated we get, no doubt about it. So shall meet you in the next session.